Hi there, guys, and welcome to this edition of the Wise Crypto Sunday Special with me, your host, Chris Coney. My guest analyst again today is Alex, and the macroeconomic topic we will be discussing this week is Bitcoin, bonds, and hyperinflation. So first of all, Alex, welcome back to the Sunday Special, mate.
Thank you very much. Glad to be here.
Glad to have you back.
Discuss this topic.
Absolutely. So you and I were discussing this trying to figure out how we're going to do this episode, and I came to you and said, well, this is my idea. But I've written all these notes about it. So what we're going to do, I'll run through that, sort of like set the case out as far as I understand it, and then they'll do a bit of discussion around that, okay?
Great.
Okay, good. So this episode was inspired by Ray Dalio. If you guys haven't heard of that guy, he's the founder of Bridgewater Associates, the biggest hedge fund in the world. They got like $140 billion under management. And he went from being a Bitcoin skeptic in the early days to recently where he announced that he's bought some Bitcoin. And then the famous tweet that went around was he said he would rather own Bitcoin than a bond. That's a huge statement. So he said that principally because he doesn't believe that bonds are going to pay more than inflation. So that's where we'll start. Right? So the trouble I find with this topic is that it's quite complex. I was speaking to Juan about it in the chat. And it's like monetary policy meets fiscal policy meets interest rates, government bonds, treasuries, investors, retail investors, and the central bank all buying the assets and different incentives at different times. And it's trying to keep that in balance. And if it gets wayward, it gets wayward really bad really quickly. So today we're just going to try and stick to one facet of it, right? For the sake of time, then we'll come back and maybe look at other facets in the future. So interest rates on government bonds, right? They're a two-sided market like any other. On the one side, governments want rates to be high enough to attract investors because investors want the best yield possible. But on the other side, that interest rate is the rate that the government is paying on the debt, which is what a government bond or a treasury is. And if that interest rate gets too high, it will be very, very attractive to investors, but dreadful for governments because they're going to pay an enormous amount of interest. So it's fine as long as interest rates remain in balance, whatever that is, as long as the market is sweet enough for investors but not too expensive for governments. And that's been happening for a while, that whole balance, since government bonds were created. But what's been happening over the last few decades is, massive government deficits, which is spending more than you earn, basically, just like any individual. That's good financial advice. Live within your means, except governments don't do that, do they? Right? They spend more than they bring in. In fact, the most of the time, the deficit, like their debt, for ongoing years, is financed by borrowing more money, which is kind of like, I always think about, it's the same on an individual level. It's like, okay, I can't afford to pay my debt back, so I'll take out another credit card and another personal loan in order to keep up with the payments on my existing debt. Now, that is ultimately not sustainable. Eventually, you're going to run out of credit and you're not going to be able to borrow it anymore because whoever does a credit check on you is going to go, well, you don't earn enough to take out this much debt. Yet governments seem to get away with it because they've got the ability to tax citizens supposedly to infinity, which obviously isn't plausible. So what else do I want to say here? So when the government wants to issue new debt, if there's no appetite amongst retail investors for those new treasuries, well, the central bank is always there to create new currency and buy those bonds, right? Now, the last time I was looking at this, or was it US government spending.gov or something like that, statistics website, it says the last time the government had a budget surplus where they spent less than they earned was 2001. It's usaspending.gov. So that means every year from 2002 until now, they've been spending more than they've been earning. And that has accumulated in 2020, the coronavirus pandemic relief fund, where they spent $3 trillion more than they brought in. I mean, that's just like a mind-blowing amount. When you look at it on the charts, the bar on the bar chart for 2020 is just way, way bigger than anything you've ever seen. So as governments issue new bonds, the central bank creates the new currency, and they use that currency to buy it, right? And that's how the amount of money in circulation increases. The new money is created. That new money is first spent by buying the government bond. The second transaction is where the government then spends that money on expenditure, pays its staff, infrastructure projects, hires private contractors, building companies, stuff like that. And at that point, it's made it into the pockets of your average man who then goes out and spends it in their local community, right? So the central bank gets the greatest purchasing power. The government gets to spend it the second time before that new money has created any kind of inflation whatsoever. But the last people to get it are Main Street. So that's where the solution becomes the problem, right? The more money the government spends into existence by borrowing from the central bank, the greater the pressure on price inflation, because you're only supposed to create more currency to keep up with a fast-moving economy, right? If the dollar is moving around at a high velocity, well, you need to put more money into, to keep up with that. But just creating the currency doesn't create that velocity, so that's the problem. So putting money into the economy without greater amounts of goods and services, it just puts pressure on price inflation. So if the government deficit were to be the same each year, maybe that would be okay. But it shot sharply in 2008 after the financial crisis because banks needed a bailout of liquidity. Then it started to reduce up until 2015, but then has increased every year since then. And now it looks like an exponential increase since the coronavirus relief fund, right? So back to inflation. If the rapid acceleration in new money entering the economy causes prices to rise too fast, then the central bank reacts to that by doing the other thing they can do. Issuing money is one of them. Increasing interest rates is the other. And that's typically what they will do to discourage people from borrowing, including the government, right? Because they want to discourage new credit creation to slow down the expansion of the money supply. Or, well, that's okay. It'll have the effect of cooling down spending, but it also cools down the government's spending, right? Well, the higher the interest rate goes, eventually gets to the point where the government has this, massive mountain of debt, which is expensive enough to service anyway. But then if interest rates start creeping up, they're in big trouble because they need to borrow more and they need to spend more on interest payments. So that's really where it gets catastrophic. So back to Ray Dalio. If he sees 10-year government treasury bonds paying an interest rate, I looked it up the other day, 1.6%, right? But then if he calculates price inflation to be 5%, well, the bond is no longer viable. If he parks his money in a bond, if he parks it in cash, it devalues by the rate of inflation. If he parks it in a bond, that helps a little bit by subsidizing it by 1.6% interest. But if price inflation is 5%, he's still losing 3.4% of the value in his cash balance every single year. And that is probably why Ray Dalio has turned to Bitcoin and why he would rather hold it than a bond. So as long as Bitcoin outperforms basic price inflation, you're better off holding Bitcoin despite all the volatility, right? In the long run, if all you do is, if you have 5% inflation and Bitcoin goes up by an average of 5% a year, you are better off doing that than a bond that yields like 1.6%. And we know governments can't afford 5% interest because they're struggling now at 1.6% interest on the massive pile of debt. So bigger pile of debt causes them more interest payments, higher interest rates causes them higher interest payments, and they're already in a massive deficit with no end in sight. So tripling their interest payments by putting interest rates or bond yields up from 1.5% to say 4.5% would just absolutely bankrupt them. So that's just education, not investment advice, of course. So that's basically the way I thought about it. That's all the thoughts that came to my mind when the Ray Dalio tweet came out, and I thought, okay, what does he mean? He would rather hold Bitcoin than a bond. I knew that, intellectually, but I thought, let me just break it down and look at it in a systemic way. So I'll shut up at that point, Alex. And what comments have you got on all that? You got anything to add to that?
Yeah, I mean, that was a great walkthrough of the whole situation. And it shed some light as to why Ray Dalio and perhaps other big time investors are looking at Bitcoin as a hedge against inflation. I would say almost every year Bitcoin's existence, it has returned more than a 5% return. So the likelihood that it outperforms inflation is pretty high, especially when you're considering, maybe a 2 or 3 year hold.
Mm-hmm.
It's most likely going to outpace inflation by a good bit.
That's a good one. I don't know how long people typically hold a bond for, but that would be a perfect bit of data to have to say, okay, so if you hold a bond for a year or 2 years, well, what would it look like if you held Bitcoin for the same length of time, right? That would be a fair comparison.
Right. I mean, I do know that if looking at any 4 year point, in Bitcoin's existence, if you hold for more than 4 years, it's been profitable.
Right.
There's literally no 4 year span in Bitcoin's history where it has returned a negative yield. So,
Right. If you take a 4-year cycle, yeah.
right, exactly. It depends how long you want to hold it. The longer you hold Bitcoin, the better off you would likely be.
Sure. So I
Um,
go on, carry on, mate. Go on.
no, I mean, this is a very interesting topic. Um, I'm really curious to see if big investors are going to move away from bonds and into Bitcoin. This could kind of help to push the price of Bitcoin upwards as well, depending on the amount of volume that does come in. And also really go to change the tune of people's perception of Bitcoin towards more of this store of value, which a lot of Bitcoin insiders have been pushing for a while now. It would kind of be validating for the space.
So investors used to use, well, still do use, bond almost like cash in their investment portfolio, right? So rather than holding cash, you would at least put, what do they call it, the risk-free rate. The risk-free rate is usually putting it into a bond because treasuries are seen to be risk-free, right? And that would be then the
Right.
benchmark, parking your cash in a bond, 1.6%, then you have to have some alpha on top of that.
I would argue that when the yield of those bonds and inflation, it's not exactly risk free.
That's a good point. Well, yeah, exactly. It's not risk-free if you include the rate of inflation, which no one seems to be able to agree on. Like, what do you think about that? Like,
Well, I don't know. Yeah, I've heard many people saying that inflation is not a big scary risk, not something to really worry about at all right now. I understand those people not wanting market investors to panic. That's understandable. But I think downplaying inflation as a whole is not the move.
why do
I
they
don't know how else
downplay
to put it.
inflation?
I don't know how else to put it there, but just ignoring it completely, I don't think is the way to go.
Why do they do that? Why do they downplay inflation in the eyes of the masses? What do they think the masses are going to do if if the masses think that price
I think
inflation is here?
if the masses were worried about inflation, perhaps they would move their money elsewhere. Perhaps they move it towards Bitcoin.
Oh well, okay, fine.
They would most likely, move their money out of cash and
Right,
bonds.
that's it, isn't it? That is it. It's the Ray Dalio again on Main Street. Perhaps so he's a wise guy, right? 'Cause he's a super wise guy. So of course he can do that 5% inflation, whatever it happens to be, minus the risk-free rate. Boom, there you've got your real gain or loss in purchasing power. Whereas Main Street doesn't think like that. So they're looking to news agencies, the government's official figures, whatever, their opinion, for clues because they haven't got time to study it. And I suppose that's to their disadvantage. It's quite time consuming to keep an eye on all this stuff. And if you're Ray Dalio, you got $140 billion of assets. You better be paying attention. So fine,
Right.
he should know what's going on. But Main Street, who gives their pension, 401k, whatever, to a wealth management company, they're assuming they're keeping an eye on things.
And I would argue that those Main Street people also have a lot more to lose.
Good point.
I think that they have a lot smaller of a margin where the downside is a lot higher for them if their assets are devalued by inflation.
That's a good call. That is a good call. The Ray Dalios of the world would, I imagine,
They'll
he's
be
got
fine.
plenty of assets that are without debt against them. He's like, owns them outright. So I suppose even if his business imploded, like Bridgewater Associates went bankrupt, he personally would be absolutely fine.
And I would argue that Bridgewater could afford to lose 3.4% for a few years. It's 3.4% could be the difference maker between making rent or a mortgage payment for your average Main Street small business owner.
I didn't quite catch that. What do you mean? Go and break it down. The 3.4%.
Yeah, exactly. So, if you just deduct 3.4% of a monthly cash flow for, say, a small business owner on
Okay,
Main Street,
sure.
that could be the difference between, being in profit that month and losing money.
Totally get you. And it's invisible because it's inflation, the silent robber, they call it, the silent tax. It doesn't show up on your accounts. Not really. It's a very
No,
subtle
but
decline.
again, taking this small business, if the price of goods were to go up by an additional 3.4% or 5% for a restaurant owner, that could cut into their profit margins pretty well. I mean, it's a very small profit margin, a restaurant business. And hacking 5% off of that, like I said, it could make a big difference. You might not be making mortgage payments that month.
I'm totally with you. I noticed big corporations are good at systematically raising prices every year. Like the telecoms companies, they always send me an email saying, "Oh, due to inflation, this is going to be the new price, and we're sticking 5% on it or whatever it is," and they do it like clockwork. Small businesses are not that, or in the main, don't seem that systematic with it. Is that because I don't know because they're not aware of it? I don't know.
I don't know. I mean, I don't know exactly, what would happen with that. But again, just sticking to the same example, if the patrons of those small businesses, if they're also having to deal with an additional 5% inflation each month, if that little restaurant raises their prices, perhaps those patrons, the typical patrons, they're just going to have to turn to the bigger businesses because that's all they can afford is the cheaper goods that those big businesses can offer.
The economies of scale.
So exactly. So there's a ripple effect that trickles all the way down. When inflation is high like this, it's a scary thing, and there are many consequences of high inflation like this.
So let's just go back to that parking your cash in bonds thingy, because that is important when you're comparing bonds to Bitcoin. So yes, Bitcoin store of value, fine, but over what time period, right? You're saying 4-year cycles, you're pretty safe if you bought $100 worth of Bitcoin at the beginning of a 4-year period, and 4 years later, almost always historically, you're going to be up, or at least pat,
Right.
even on that $100. Whereas if like Ray Dalio is using it as a place to park capital, well,
Yeah.
the bonds are not that volatile. They're not as volatile as Bitcoin because they're so liquid. So that's another point, which is if people like Bridgewater and anybody is going to seriously consider Bitcoin instead of a bond for the same purposes, well, I just don't think Bitcoin's just not liquid enough yet, right? It's still in just over $1 trillion market. I off the top of my head don't know how big the bond market is. Do you?
No.
No? Okay.
No.
But I imagine it's astronomical compared to the size of Bitcoin. So I have
I
to look
would
that
I
up.
would assume it's a lot bigger than $1 trillion.
Right. So that is a bit of a problem. It'd be a bit of a squeeze, and perhaps that's where, if there were a panic, if there were a panic in the bond market, and people were aware of Bitcoin at least, there could be one of those stampedes through a very narrow door situation.
Yeah, I mean, there are a lot of worrisome things that could happen if people do switch away from bonds in a rapid manner. I mean, first of all, it's worrisome for the government if you're not having people buy their debt. Second of all, it's hard for the institutions in Bitcoin to keep up with a surge in demand.
It is.
You see exchange outages pretty often that's just retail volume really that can drive these institutional outages. So I don't know if the infrastructure is there for Bitcoin yet in order to handle something like this. Now, that's not to say that it can't happen. There could be a stampede of people away from bonds into Bitcoin, and Bitcoin's infrastructure will just have to manage. I don't think that the existing infrastructure around Bitcoin is really robust enough to handle that many more people in the space. So that is something to worry about.
You're not talking about the Bitcoin network, are you? You're not talking about the Bitcoin
No,
network.
I'm
You're talking about
the
the exchanges.
I'm talking about the infrastructural ecosystem around Bitcoin.
Right.
So I'm talking about exchanges. I'm talking about
the
lending platforms,
wallet providers.
wallets.
Yeah, sure.
What's the word I'm looking for? Custodians.
Yes.
I mean, they're and that's another big thing. I think for really like a huge rush into Bitcoin like this, you really need a great custodial ecosystem. And I know there's some companies out there that are doing very well and they're growing, but I don't think that they're ready for a huge influx.
Stampede. Yeah.
Yeah. Sorry about that.
All
I
right,
had
mate.
an internet issue.
Okay.
Where did I leave off there?
Yeah, I said you're not talking about the Bitcoin network. You're talking about the infrastructure around exchanges, wallets, etc. And you said we're not ready for a big stampede as yet. Where I was going to go with that was like because we're talking about human beings here, it's very difficult to make it orderly. It's not like wait, no, we'll just have
Yeah.
this many people and just line up, and you'll in turn when the price goes mental, that creates the demand, and then it disappears. So it's kind of hard to predict the demand. You don't know when the masses are going to suddenly act on Bitcoin and the infrastructure.
Right. Not to mention the fact that a huge surge in volume like that is going to send the Bitcoin price to the roof. So again, those Main Street investors, they're gonna have a higher price to pay to get into Bitcoin. So it's gonna be a lot more expensive for them to store their money.
That's okay for the retail investors, but I wouldn't want because we were talking about bonds, right? And the large bondholders are the wealth managers, the institutional investors, investment banks, and so on. So I wouldn't expect. I hope they don't wait till then before they wake up and start allocating a portion to the asset class that we call Bitcoin. Because
Right.
right, because at least then they. I mean, you would think the institutional investors would be smart enough to average in over time and all that lot. You
Yes.
know what I'm saying?
No, you would assume that they'd be smart enough.
You'd
You
assume so.
have to factor in the hubris though. These are people that have been downplaying Bitcoin for a decade now. And for them to suddenly capitulate at this point just proves that they've been wrong for 10 years. So a
True.
lot of these people are too prideful to admit that.
And even right, that's a good point. So it's a good point. So even it took Ray Dalio long enough time to turn around and see the light, but yeah, but he
Ray
already
Dalio is one of the smartest investors of our
well
time.
exactly. It took him a while, and he knew what the math we did earlier on. Like he doesn't think that bonds will outpace inflation. That's quite simple math, though. So I'm just a rhetorical question. Did you not notice that before now? Like, where the first time he came across Bitcoin, didn't wasn't that thought already in his head? Like, bonds aren't
And that's
inflation, inflation.
that's what's interesting to me about this whole thing is that this isn't exactly a warm embrace of Bitcoin by Ray. This is this is him just suddenly realizing that perhaps in times of Bitcoin's a better store of value than government bond, which I mean that's not exactly the hottest take out there. You know, Bitcoin typically tends to yield more than 5%, and government bonds during times of hyperinflation aren't exactly great places to park your money. This is simple math to come to this conclusion. And I'm glad that Ray Dalio is starting to think this way, but this is no genius take on the
Exactly.
matter.
We also don't know how much he's bought, like what allocation. And it's not clear to
That's
me. I
true.
don't know
It's
if you
true.
know this. It's not clear to me whether he was talking about he bought it for his personal portfolio or whether Bridgewater bought it. I don't think that was obvious. So when he says he would rather hold Bitcoin than a bond, is he speaking personally or as a Bridgewater associate? I don't know the answer to that.
I don't know, but you would have to assume that those two things are tied. You would assume that he's investing the same way that Bridgewater is. I,
Very true.
I, I, I don't know. That could just be an ignorant assumption on my part, but I'll give him the benefit of the doubt there.
Right. Sure. Sure.
Yeah, and another thing that I want to point out while we're on this topic is that there are lending platforms right now in cryptocurrencies that are offering 5% returns, even higher. Most are offering 7 to 8% on US dollar stablecoins.
Very good.
And so
Very good
this
point.
is already vastly outweighs the returns of government bonds and it outpaces potential inflation. So, just simply putting your money into a stable coin and parking that stable coin on a lending platform, very low risk thing. And you're already outpacing inflation by a good amount.
What are you gonna say? What are you gonna say to that? Like, And it's just a matter of discovery. People just don't know this exists.
Exactly. That's the point. It's I think people just haven't really explored this happening yet. It's not to say that there isn't great solutions to this exact problem. I mean, this is pretty much what Bitcoin is created for. So
Maybe
yes, people look at Bitcoin in times of hyperinflation. This is the solution.
so. The last point I'll make on this is, it's probably because if you've been in traditional finance for so long, it sets your expectations. So what I mean then is when someone watches this and hears you say that about stablecoins and lending platforms, they might go, dismiss it based on it's too good to be true. Can't be possible.
Yes, it's possible. It's happening. It's been happening.
You're doing it, right?
I'm doing it. Yes. This is, and believe me, that is one of the most basic yield earning strategies in cryptocurrencies.
Yeah.
So yes, this is real.
So we're definitely sold on it. Ray Dalio has capitulated. I wonder how much influence that'll have over his peers, but we shall see.
I do know that Ray Dalio is very highly respected in the world of finance. I mean, many of my previous employers were former employees of Bridgewater.
Okay.
Highly valued Ray Dalio's opinion. I would go to say that this is probably going to stir some feathers and hopefully get a little bit more people excited about Bitcoin.
Cool stuff. Cool stuff. All right, Alex, thank you very much for being on Sunday Special. I think we'll wrap it up there. Got any closing comments?
I don't. Thank you very much for having me.
Great stuff. Well, that's all for this edition of the Wise Crypto Sunday Special. Thanks, Alex, again for being with us. Keep your eye on your inbox for the next episode of the Wise Crypto Sunday Special. Until then, it's me, Chris Coney, saying bye for now.